This 19% monthly dividend ETF pays more dividends and income than JEPI and JEPQ. Investors, yes, if you love JEPI and JEPQ and income, monthly dividends, making money, passive income, and so on and so forth, then you're going to love SVOL or SVOL by Simplify ETFs. Now, in my opinion, I think SVOL is great for diversification. This is a great ETF for added benefit of more diversification in your income portfolio, solid returns, great performance of consistent income, high income, almost 20%, and so on and so forth. So if you love income, this ETF could be for you. We're going to go over a full ETF review, the pros, the cons, who it's for, the risks, the reward, the benefits, the downsides, and so much more. Everything about this ETF is all answered in this video, from dividends, future performance, past performance, and so on and so forth. So if you will, welcome Mr. Shailesh Gupta from Simplify ETFs.
Thank you, Marcos. Always pleasure to be on webcasts like this to get connected with the investors. ETF industry is sort of a democratic process that it's always good to have feedback, conversations. We can design and improve the products to include investor preferences.
We're going to be providing our audience a full and complete guide of SVOL, one of your guys' most popular income enhanced strategy ETFs for beginners and maybe for those who want to invest in SVOL, or maybe some of those concerned or maybe on the fence about purchasing this ETF product by Simplify ETFs. So does that all sound good with you? And if that all sounds good, we can start with the first question.
Absolutely.
So my first question is, can you provide our viewers with a brief background on yourself and what made Simplify ETFs launch SVOL?
Right. So I'll start my background from, after the grad school. My grad school was University of Chicago, studied financial engineering. So bringing my background in finance and engineering put together, combined, design financial products to meet investor needs. And the math which goes behind finance traditionally was the industry would utilize PhD physics, the rocket scientists, so to say, as they call it. But subsequently now currently financial engineering program is available for, students who do not really want to do a PhD but want to understand the math. That's what I studied. So basically gave me understanding of the derivatives market, how the futures and options are priced. And using that background, I had been trading derivatives over last 25 years. And starting at PIMCO, which is one of the largest fixed income managers. It's not only one of the largest, but also most innovative, so to say. It's like they would hire best of hedge fund industry talent and deploy, all the best possible ways to enhance returns in a very risk managed way. So hedge funds typically take a large amount of leverage, so they make a lot of money, lose a lot of money. But PIMCO philosophy is that you can do those trades, but in a smaller amount, so you can actually have consistent performance over a period of time. And that's what I learned and applied my education in that environment. And the same philosophy we are bringing to Simplify with many of my colleagues are from the same PIMCO alumni or PIMCO university, as one might call it that. I learned more about the industry from my experience at PIMCO as compared to, one would, think that you go to a grad school and then you're up and running, so to say. The experience was very, very helpful.
What made Simplify ETFs launch SVOL? There's so many cover call ETFs in the space with super high yields that are basically equity based, and SVOL is a very unique strategy. So can you touch on that?
Yeah. So SVOL, one of the unique features in SVOL is trading VIX, right? So VIX has been my hobby, so to say, over last 10 years. That as compared to the bond market, it's a much smaller market. So it was sort of a pet project on the side, so to say, that apply the fixed income, the interest rate strategies, towards the equity market or VIX strategies, how that would work, so to say. What I find in the VIX market, that VIX goes up, VIX goes down, and there are ETFs which lose a lot of money buying VIX because there is a lot of bleed. On the other side, ETFs which are shorting VIX also lose money. So question is who makes money? Somebody is making money, right? If everybody is losing, all the ETFs are losing money, so then somebody must be making money. So I use the same PIMCO concept. The good strategies, like the size of the position matters a lot to achieve consistent returns over time. You see hedge funds, 1 in 10 hedge funds approximately would go under, every year, so to say. But, that's because of the high leverage, right? So if you run those strategies in a small basis, then you can stay in the game for a long period of time and actually, generate return. So that idea we applied to SVOL, that best time to get into a short wick strategy is after a risk event like COVID, right? So after that, okay, so we want to get into wick strategy, but we want to design a product with a small amount of wick exposure, so which can consistently generate yield, but at the same time doesn't blow up. You stay in the game, so to say.
Now, can you go over the exact investment objective of SVOL?
Right. So the investment objective is to deliver performance related to approximately 20 to 30% short wick. So give and take around a quarter of the portfolio, risk return profile, it would be similar to that. And since VIX is a very high risk, high return kind of a product, even a small portion of that can generate high level of dividend. Typically, it's in the life of the product, we had been originally targeting around 15%, but in the current environment, as we notice the tariff tantrum, I may call it, but this was a sort of a mini crisis like COVID. So again, this becomes a very interesting environment, to generate yield out of VIX market. And we also have added additional yield sources that in not just VIX, but we efficiently invest the collateral, in fixed income products. So, with interest rates still reasonably high, and additional strategies on that, provide additional return. But we also notice that, as you mentioned, the covered call strategies are very popular. In these strategies, investors take stock market risk, but then gives up the upside and collects the premium instead of that. So these strategies are very popular over last 10 years or so. The effect of that is, if there are a lot of investors on one side of the market, the opposite side kind of becomes interesting. That if we look at this covered call index as compared to the market index, the Bloomberg chart shows that the covered call strategy underperforms the S&P 500. Right. So effectively, when you are giving up your upside and collecting the premium is not enough to compensate for all that upside. And interestingly, previous 10 years, it was the performance of this benchmark is similar to the S&P 500 or the market index, so to say. So because of billions of dollars getting invested in covered call strategies, sort of anti-covered call strategy has become interesting. Like, if a lot of investors are selling calls, then the investors who buy calls, can make a lot of money, right? So especially this year, buying call options has been very profitable. And we have started doing that. And because of that, we have increased the dividend of SVOL to around 20%. So, this additional source of return, we are expecting good results out of it in times to come.
Now, my next question is SVOL's income sustainable because of that high yield of around just under 20%? But I know you guys are targeting 15%. And you were kind of just saying that, of course, the cover call strategies, for example, if you buy something like a cover call strategy on the S&P 500, it's going to underperform the underlying index just because you're giving up that upside and capping it from selling the covered calls and collecting the income. So I guess to kind of just a couple steps back, is SVOL's income sustainable, and why? Or why not?
Right. So the distribution yield is managed, right? So we are distributing this yield expecting this performance, right? So, VIX strategy can make 5 to 10%, the bond market make additional 5%, and these buying call options, the ones which are being sold in the covered call strategies. If the covered call index is underperforming the S&P 500 by around 6-7% over last 10 years, that means buying call options can generate that return. On average, that was has the past performance is not an indication of the future performance or a promise for the future performance, but at least the expectation is there. So additional 5% or so we are expecting from the option buying program. And together, we believe the 20% is very achievable. But as you know, targets are targets, and we will, hopefully try to beat it, and maybe, it can be even more than that for that matter. So in case the performance if the funds start generating even more than 20%, there's potential for distribution to increase as well.
What investor is SVOL for? Is it income seeking investors, those who want to live off the income someday? Also, is it for long term investors who are growth oriented?
Yeah, it is definitely for income seeking investors. The difference from other strategies is that SVOL has a lot of flexibility. That originally we started it as only a short VIX product, because VIX, as you know, we launched this product just after a year or so after COVID. So there was a lot of yield in the VIX market. And at the time, the interest rates were close to zero, with 2-year treasury yielding 0.1%. So, subsequently, interest rates have increased. So over the period of time, the yield available from the VIX decreased, but the interest rate, was compensating for that. So we could have that consistent 15% or so. But what we saw over last year, that the premium in the VIX market had declined quite a bit. Right. So all the fixed income continues to give good yield, but the yield from the VIX had declined. And so we added additional tools to be able to generate those returns, so that we can, achieve the, total return of the order of the distribution yield. And now that because of the tariff tantrum, we have extra sources of yield, and now the VIX has become very productive again. Put together everything together, now is kind of a great environment to harvest the yield from various sources. And we have the full flexibility as the market environment changes, move from more capital from one sector of the market to the other.
Now, should investors who want to invest in SVOL have a more intermediate or advanced knowledge of investing, of stuff like selling options, how roll yields work, the VIX, futures, etc., and are beginners suitable for investing in SVOL and can just rely on the income and just rely on Simplify, doing all the hard work to generate hopefully some solid returns long term?
So SVOL is a very active fund. Active funds are good for passive investors. And while, a passive strategy, one would need to be very active, to be in and out of the market or switching from one strategy to other. So we are effectively doing that for the investors. So as long as you understand the risks in this strategy, that this is an equity income product. The value invested would depend a lot on the stock market. That if the market comes down, like COVID, the NAV would be coming down, and the NAV would be fluctuating quite a lot, just like the stock market. And some stocks are more volatile than the market, and some stocks are less. And as well, similarly could sometimes be more volatile than the stock market, and sometimes less, so to say. And so given the flexibility, we will shift the strategy towards the most attractive part of the market. But as compared to fixed income market, this would be a much more equity centric strategy, so to say. So as long as you understand the risk, you can harvest the high yields available.
I'm going to jump into one of my later questions, but I think it's perfect for right now. So, SVOL was performing amazing since inception. And earlier this year, we saw some NAV erosion and the dividend also be cut as well. And that was a big concern from investors. Income can't always be consistent. Performance can always be going up. There's going to be fluctuations in the market, as well as the VIX, which will also affect SVOL. So, my question is, can you explain why SVOL's dividend was cut in the last year? But I will say, I just checked your guys' distribution and it's actually going back up. Kind of what you were alluding to on how SVOL might have fixed that, I guess, enhance the strategy to maybe make the income more because investors might have just sold out of SVOL, not understanding the strategy. And I wanted to have you on to explain why SVOL is, I guess, not making a comeback, but going to provide investors with hopefully that confidence of investing in SVOL. And also, why was it NAV eroding last year? But before I do that, I had my own notes on what I think happened for the dividend to be cut and the NAV to erode. So I put on my notes that the dividend was slashed probably because of rates being cut in Q4 of last year. So I was assuming that SVOL lowered their dividend as a result of this, and also because of rising inflation expectations into this year, which probably pushed up the yields of intermediate and long-term bonds, which are smaller portions of your guys' portfolio because the cash is also held in bonds. And also, those are going to be rate sensitive to interest rates. So I was assuming that there was going to be some losses in those bond funds. And also because of interest rates dropping, I know you guys have a lot of money in treasuries, so the yields would drop on those as well because a good amount of the portfolio is invested in cash, which is also invested in fixed income products to generate yields. Or was it because the roll yield on the VIX was negative during that time that caused the yield to drop? And also the yield on short-term bonds dropped and modest losses in the long-term bond portfolio. I said a lot, but I want you to touch on NAV erosion, dividend yield dropping, and why investors should be confident in SVOL, and if my analysis was right.
Right. So, as you mentioned, SVOL can be a complicated strategy, and actually it has become even more complicated. One needs to be complicated to, harvest the yield from various sources in the sense. Till last year, there were two sources of yield, the fixed income and the VIX. And the Fed was reducing rate. So that had, that was reducing the yield available for the product. But more importantly, as you mentioned on the VIX, like there are two elements to a VIX strategy. When you're shorting VIX, well, one, you want the VIX to be high enough, there is room for VIX to go down. But more importantly, the shape of the curve. As you mentioned, you studied how the VIX strategy works, then you are rolling the futures contract, and a VIX curve is usually upward sloping, as we can see in this Bloomberg chart. As compared to last year, since this tariff tantrum, the VIX is higher as well as the curve is steeper. So now there is sort of a roll down potential as well as benefit from declining level of VIX. So VIX strategy is a lot more attractive as compared to last year. So the last year was a very challenging environment for VIX strategies in general. And on top of that, the interest rates were being reduced. So all those factors combined were having a negative effect on the sources of yield available. So as we saw that environment, we added additional source of return and yield to the product. And again, we saw a lot of volatility in the early part of the year, but the side benefit is that now we have extra sources of yield. One of the features for SVOL as compared to other VIX strategy is its ability to recover from VIX event. That typically, if you notice that if you invest in a VIX strategy and the VIX blows up, the short VIX strategy loses money, and it takes a while for that strategy to recover. But as compared to other VIX strategy, SVOL has demonstrated its ability to recover, from that VIX episode. And now we have additional sources of return and yield for the product. So I think in times to come, SVOL has larger flexibility and more sources, and these forces are better than before, so to say. So I think it's like a target-rich environment currently, and that's why we have increased the distribution yield as well.
It sounds like SVOL is going to make not a comeback, but investors are going to be super excited about this news. All the new flexibility and the new tools that are being implemented into the strategy to have investors be confident in this strategy, right? The Fed probably won't cut rates as fast or as they did, and longer term bond rates have adjusted to reflect higher inflation expectations. We're also in a more normal VIX futures rate curve. And from what I'm thinking, that SVOL should be not cutting their dividend anymore, but providing, maybe the dividend's going to go back up and be stable, right? So people could not expect 27 cents. I believe the last distribution was about 30. From what you're saying, it sounds like the strategy is going to be working as usual this year, and hopefully the active management will also help on mitigating what happened recently. But it's also not in the hands of SVOL. It's also in the hands of the market, and also in the hands of Fed rates and whatnot decisions. So to kind of wrap that up, we're going to be moving on how does SVOL stack up against its competitors. There are many covered call ETFs in the space. You got YieldMax ETFs with super high yields. You got NEOS products. You got JEPI, JEPQ, and so on and so forth. So what are your thoughts on how SVOL stacks up against these ETFs? And should investors maybe complement SVOL with these strategies and whatnot?
Yeah, exactly. I mean, SVOL is unique in the sense that one, it targets very different sectors from other ETFs, and secondly, it has much more diversified and much more flexibility to move from one to the other. Like covered call strategy currently, selling calls is effectively on its own losing money. So buying calls should be making money, right? So, that is a source of return which I don't think is being implemented in any of the competitions, you would call it. I wouldn't really call competitions, but more of, a yield investor should always look for diversification. So SVOL itself is diversifying within itself. And if you are investing in covered call strategy, you should definitely consider SVOL as a diversifier. In the yield markets, one yield strategy may work in one environment and the other. Like, for example, last year, the VIX strategy was not very effective while the covered call strategies were doing, so well, so to say. So now, in your words, VIX strategy is much more attractive. It's very easy to see when the VIX strategy is attractive in the sense that after crisis kind of, it's like an insurance business that California fires would result into higher insurance period premiums, right? So insurance company would have lost some money during the fires, but subsequent years through higher premiums they will make all that back, so to say. So in these yield strategies, the best environment is after a risk event, so to say. So VIX is very attractive. Fed rates are really, reasonably high. And I'm very happy to see, a lot of demand for covered call strategy makes it a very target rich environment for me to implement a call buying strategy, so to say. So all these three sources of returns, I am expecting that should put together should be able to give us a healthy yield for the level of risk in the product.
SVOL is a great diversifier in a portfolio, and also that the performance since a quote unquote catastrophic or a turmoil event is because SVOL has been having some great performance in the last 3 months. You'll see a chart on your screen on that performance compared to other strategies, as well as just like the S&P 500 and how SVOL has been able to do exactly what Mr. Gupta has been saying of that, good performance after some of these events, but also that these tools are being implemented. The strategy is going to be more, I guess, enhanced or maybe more quote unquote bulletproof and whatnot. So our next question is, I saw on the Simplify ETF's website that there was different fees for this ETF. You got stuff like management fees, distribution and services fees, other expenses, acquired annual fund operations expenses, and so on. So is the expense ratio 0.72%, or is it a different expense ratio? So what is the fee for investors to invest in this product?
Right, so the management fees is 50 basis points, and there are additional fees that SVOL would take exposure in other simplified ETFs, which is strategies which SVOL doesn't have the ability to do directly. So those strategies, that has a little bit of expense, and could be some distribution expenses. But additionally, SVOL also implies interest rate repos. So repos are a little bit of a complicated product where you borrow money against T-bills, and so the income earned on T-bills is not part of that. Like the borrowing rate gets included in the expenses while the income is not deducted from it, so to say. So sometimes that number can be exaggerated, but the net fees, I think around 50 to 70 basis point would be a reasonable estimate. Sometimes the number on the website may look higher, but that could be because of the repo expenses. Overall expenses one can estimate to be between that range to 50 to 70, 75 basis point is a reasonable estimate.
Can you also, I guess, touch on again the purpose of the ETF of SVOL being a good amount invested in bonds? I'm assuming it's for downside or risk mitigation and to, of course, generate some additional income and yield to the portfolio and as well as collateral. So can you touch on that again?
Right. So the bonds definitely help. Not only they provide yield, but in case we run into a recession kind of environment where equity income strategies, start having a drag or a headwind, then in those environments, the bond strategies provide that extra, buffer, so to say. So for traditional investors, one can think in terms of the 60-40 kind of, popular portfolio. For growth investors, one can use the same analogy for income investors, that we should have some kind of a balanced portfolio that who knows about the future, so to say, so when the recession hits and so on and so forth. And if those bad scenarios hopefully do not happen, but in the meantime you keep collecting healthy amount of income from the fixed income products.
Will SVOL perform better if covered call equity strategies perform less and vice versa? I don't know. I'm just asking this question out of the top of my head.
So like in a typical covered call strategies, there are two sources of risk and return, so to say. One is just the equity market. Two is the level of volatility, how much premium you are getting, for those options. So both those things combined, if the equity market is having a tough time, both SVOL and covered call strategies would have a tough time. But assuming normal state of the economy where equity market is growing at an average pace of 10%, now in that environment, if the covered calls are detracting 3, 4, 5%, then there would be a drag on the covered call strategies, while SVOL will be gaining from that money lost on the covered call strategy, so to say. And then, as we talked about, the SVOL has much more diversified. So there are other elements like fixed income market. So in the fixed income market itself can be very complicated, not just the Fed rate, but what is the shape of the yield curve? What is the interest rate volatility? There is a VIX of the bond market itself, designed by our very own Harley Bassman, who is known in the investment community as a convexity maven. So he designed the VIX of the interest rate market. So we have a lot of expertise on the fixed income side, which traditional covered call strategy investors don't have that. So with all these resources available to us, we are able to harvest various sources and provide the best yield for the given level of risk in the product.
Do you have any tips for investors who are investing in SVOL already or want to invest in SVOL in the future and want to generate the best total returns? So income and share price growth. I'm assuming it's reinvesting dividends, but what's your take on how to generate the best returns from investing in this ETF product?
Right. So as I mentioned, SVOL is a very active product. And my thinking is passive investors should look for an active manager. And an active investor should look for passive portfolio, so to say. So one can construct SVOL all our holdings are published every day. All the tools are available in the market. You can construct your own SVOL, but then you would be, working your screens 24/7, so to say. So why not pay 50 to 70 basis points to the investment managers who will do it in a democratic fashion, for the group of investors, so to say. All these strategies are available in various forms, and might as well, it's like the ingredients are well available in various forms, but can you put together a good recipe is what is being done in SVOL.
Chapter on this conversation and move on to tax implications and taxes if you're able to touch on it, because top of mind, I'm just going to be assuming with how this strategy works that, of course, taxes is going to be a super important topic for income investors because you're going to be generating high income, super high yields, of course, that are going to be taxed unless you have a tax advantage account. I'm assuming that most of the income is going to be ordinary income. And I just want to confirm your thoughts on what are the tax implications of SVOL for investors.
Right. So obviously, if you have a tax advantaged account, you will not get taxed. But I do not want to give tax advice, but I would mention that if one, in an income product, if you are making an income, then obviously one should be paying a tax, and that get taxed. But on the same side, in case the product is not able to generate, the distribution is sort of a target return, right? So suppose that the distribution is 20%, but the return is only 10%, right? So you get the return of capital benefit. So you will get pretty much effectively taxed only on 10%, from that tax benefit, so to say. So I think, even for regular investors who are getting taxed, there are mechanisms available in the fund that in case the income is not generated, then you kind of get a tax benefit, from that. Obviously, if the income is there, then there's no free lunch, so to say. So it's tax efficient. It can be sort of a euphemism of doing some. I won't go out of bounds of my capabilities, so to say. I would consider SVOL to be a tax efficient vehicle that if you make money, you get taxed, and if you don't, you don't.
Now, I just want to confirm, I don't know how this strategy will perform long term. So can investors expect in the next 5-10 years, hopefully a solid uptrend, including the income? Because some people just look at the share price and they're like, oh, it's dropping. But for other ETF products with high income, but if you include total returns, that chart should be going up, hopefully over time steadily. So can investors expect some good long-term performance to the upside, total returns for SVOL? And of course, is it true that SVOL has the goal of consistent income every single month, monthly income with similar risks to the S&P?
Yeah, that is a goal, that the risk would be to the level of the stock market. Stock market on an average makes 10%, and it's my team's job to be able to generate higher returns, than that. So if we are able to generate 15%, on an average over the life of the product with the stock market level of risk, the stock market will make 10%, and with the same level of risk, if we are making 15%, that would be the dream scenario.
Now, in the event of a market crash, for example, or a big event, a huge pullback in the stock market, because of the risk mitigation strategies, as well as a good amount of the income coming from investing in these super solid low risk securities like treasuries, for example, will SVOL perform better and maybe fall less than other ETF strategies that are based off of covered calls that are exposed to equity markets? So can SVOL maybe have less downside risk compared to these other products, or what's your thoughts on that?
Right. So, the stock market has many stocks. Some have more risk, some less risk, right? So, SVOL on its Like 2022 stock market was down. US large cap equities were down around 18-20% or so, while SVOL was low single digits, so to say. So there could be potentially periods where the risk is lower and sometimes the risk could be higher. So those are depending on the market conditions, but over long horizons, one can expect the risk to be of the same order of magnitude as S&P 500.
Now, will Simplify ETFs ever pay weekly income off of a strategy like SVOL, or will it just focus on its baby for monthly income? So, will you guys ever do a weekly income pair like SVOL, or will it just be monthly?
I mean, there's no plan on the horizon, but I will take that as a feedback and discuss with the team how feasible, operationally that is possible to do it, so to say. And if there is, if we hear that from many investors, that is a preference. So I don't particularly see from a fund manager point of view, we can certainly provide that. I have no qualms, no restriction from my side, but then it would be a lot of people involved to be able to make that happen, so to say.
Yeah, I mentioned that because I'm seeing all these other ETF issuers come out with weekly income products with, I would say, more risk compared to SVOL, maybe less sustainable income, just super high yields, leverage, etc. But I think that I'm going to speak for the people that SVOL would be a great product for a sustainability standpoint and as well as the team, active management, that I think that you guys would be successful in a
Well,
weekly income product. That's just my
I
opinion.
I can assure you it's not going to be 30 cents per week, right? So that would be like too good to be true. Something which is too good to be true is often not true, so to say, right? So, if it is a weekly, then it'll be probably one fourth of the 30 cents kind of a thing. So, like, I don't know. It's a question of investor preference. Like, people have their monthly rent, so to say, like weekly rents is not a very popular thing in our market, so to say. So I don't know how much demand is there for it, why not daily for that matter. So it's a question of investor preference, and the product can adapt to those preferences.
I want to confirm that when VIX futures go down, SVOL makes money. Is that correct?
That is right.
And I wrote some notes as well that most of the returns in income does not come from income producing securities. It's actually from, so not the bonds, right?
Correct. So bonds, I think in the current environment would make around 5 to 10%, or maybe 5 to 8% or so.
I guess we have that 19% yield. So what portion out of the top of your head is made from the bond portfolio versus just what strategy you guys are doing with the VIX?
Right. So the bonds making around 5 to 8%, around half of the portfolio is in bonds, around half of that is bonds. And VIX in the current environment expecting to make close to 10%. And the balance would be made from potentially from the call buying strategy.
Now, just to confirm that the income is historically been consistent, right? Flat. So are you saying that over time investors could expect maybe the income to increase, maybe not 30 cents, maybe 31, 32, 33 down the line? Is that in the books for investors to expect for income?
Right. Again, all these are it depends on potential return. So, like the current yield, as you mentioned, is close to 20%. And in case the total return of the portfolio consistently stays above that, that means the NAV would be growing. And if the NAV growth appears to be sustainable, then that gain can be, then the distribution can be increased. But it depends a lot on the market environment, the yield available in the VIX, the potential upside from the call options, and the interest rates all put together combined. If that sustainably appears more than what is the current level, then there is definitely potential it can offer a higher return and distribution.
So I just want to confirm before I go into my final question is that NAV erosion shouldn't be a concern for investors because there's, like I said before, other income products with these yields that are 5x SVOL. And I'm assuming that NAV erosion shouldn't be a concern. Income should be consistent every single month. You guys are going to be doing the hard work behind the scenes, active management to provide investors confidence in investing in SVOL. So is that correct?
Right. So the NAV, the depletion of the NAV combined with the distribution gives the total return, right? So that if the total return is over the distribution, then the NAV goes up. If the total return is less than distribution, the NAV goes down, right? So the NAV has gone down in the past. That means the return was less than the distribution, right? So, which we have acknowledged that we have understood why that was happening, and now the environment has changed. So, expectation is also different. That if the expectation in the market going forward is that the portfolio generates 20% return, that means the NAV should be able to stabilize at this level. And in case the strategy makes more than 20% distribution, then actually the NAV can go up.
My final question for you is if you were to put yourself in a beginner level investor's shoes who wants income, what are some tips you would provide to them? Because your background, trader, 25 years in the industry, financial mathematician, engineer, rocket science, you got all this experience, and investors would love to hear what are your tips for advice on them who want income as a beginner?
Right. So the investing is about harvesting risk premium. So you first investor should decide how much risk they want to take. They want to take stock market risk or the bond market risk or a combination of the two, so to say. So what I have noticed is either investors are very risk averse, stay in bank CDs, or they go on investing in crypto. They want to double their money every 3 months, something like that kind of a thing. So one has to find the balance that the stock market risk gives a 10% kind of return and effectively around should expect a 10% kind of a yield. So if you want to generate more than that, then you can look for a product like SVOL. But if you want 30-40% kind of yield and dividend, then you would have take extraordinary amount of risk. And general advice, not an investment advice, but general advice that if you take very high level of risk, then you can also run a very high risk of losing capital, so to say. So I think 15%, 15 to 20% would again, would be a higher, if you're willing to tolerate stock market level of risk, right? But if you go towards more exotic products like crypto, then you can get, more yield, but also have much more risk, so to say. So I think one should start with the stock market, see if that level of risk is appropriate for you. If not, then blend it with the bond market. There are plenty of yield products available in the bond market, and combination of SVOL or equity income products with that can give a balanced risk profile as well as a yield profile.
That's amazing advice. Now, investors, we're going to wrap it up. So thank you so much, Mr. Shailesh Gupta, a CIO at Simplify ETFs. And investors, my opinion, that you should expect some great active management from SVOL and hopefully some great solid performance and income from this amazing alternative ETF product. Now, investors, if you guys like this video, please give it a like because this cute puppy did. And check out where I rank other monthly income ETFs right here, or another ETF interview right here. I love you guys so much. Crush in the stock market and take it easy. Peace.
Thank you. Good luck.